All right, recording. All right, hello everyone. This is SeeWing Yee from the Yee Real Estate Network. And of course, you heard my previous podcast. I invite a lot of esteemed speakers that I have a relationship with over many, many years. And today's no exception. And without further ado, I'm going to introduce you Mr. John Chen. John, again, we've been working together off and on really over the past almost 20 years, how time flies. He's extremely knowledgeable, very analytical. He does tremendous amount of research and he know all the numbers crunching. Like I said, he is a very data driven, so very precise. He's just I don't know, maybe he have an engineering background, which is cool, but he have done many a lot of business with us, selling single family home turnkeys in different markets. He has done fix and flip in different markets over the years, and he has done commercial investing. So he's always in the front end of all the change going on with real estate. So John is something I value a lot as a friend and as a business consultant because he knows so much. He been through the up and down cycle, so without further ado, yeah, Mr. John Chen, and welcome, and just speak on your mind. What's the most challenging aspect? I know right now the real estate market is the most challenging ever. I mean, even for us, there's a lot of record-breaking everything going on. So John, share with us from as a for real estate investors out there. I mean, what are some of the takeaway? What are some of the things you want to talk about today? Actually,
Yeah, I think that first of all, you forgot to mention in my intro, my biography, that I lost a shit ton of money on bad projects too. So we
okay,
got a lot of bumps and scrapes and bruises from that too. I learned from as much as I did from stuff that I made money on.
good.
And then also dealing with bubbles and everything, you kind of learn what not to do and when to see things as overbought or oversold. And, you learn along the way. But for those of you that don't know me, I'm actually based out of Orlando, Florida. So we have direct and indirect ties to a lot of the Florida markets because that's our backyard. So a lot of what I will talk about, even though we've worked in Texas markets, Oklahoma markets, North Dakota oil country markets. We've worked in Pennsylvania, both blue markets and red markets. So some with a lot more restrictions and rent controls, and then some where you have more kind of a capitalist environment where evictions are easy and you don't have rent control. So we played in both. So I have a really good feel, but most of what I talk about is from what we see in our own backyard in Florida, which is a very cyclical market in some of the hubs. And then you have some of the tertiary markets around the hubs that are, bedroom communities where maybe you're going to find better yields and still be protected in case of a hard market cycle. So anyway, that's the perspective that I speak from. But yeah, right now, like you said, it's a pretty interesting time to be in real estate because some elements feel like 2006, 7, 8, and there's a lot that doesn't feel like that. So generally speaking, 30,000 foot view, I think what we're seeing is a bubble, but it's an everything bubble. It's not like a mortgage bubble or a housing bubble. I think we are in for some type of market correction, a major market correction. Not to sound like Chicken Little sky is falling, but just from what we're seeing, the writing on the walls is that I don't think people realize that before COVID, everybody was kind of, if you're just looking at what the stock market is doing and what you're looking at as far as unemployment before COVID got here, then just by those superficial indicators, you'd think that we're in a really healthy, robust economic situation. But if you look at like the household debt, corporate debt, global debt, sovereign debt, like if you look at we're in a major debt crisis and a major everything asset bubble. And so the credit card defaults before COVID hit back in February, prior to COVID, that COVID March, we had record high car loan defaults, record high student loan defaults, 90-day delinquent. We had climbing credit card defaults. We saw that there were a lot of people that were hurting. We were tracking foreclosures at that time. So Florida is what we call a judicial foreclosure state, which means that foreclosures have to happen through the court system as basically lawsuits that the lenders are filing against the borrowers to get houses back, which means they take a little bit longer than other states. And a foreclosure in a judicial foreclosure state is typically memorialized by the lender filing what's called a lis pendens or an LP, which is the beginning of the foreclosure process. It means litigation pending, and they actually start the lawsuit. So we were tracking LPs for years before COVID hit, and they were on a major climb. So I think the misconception that people have is that COVID was the cause, or the reaction to COVID rather, was the cause of like a potential bubble, when in fact we were already in a debt crisis, retirement crisis, pension crisis, everything asset bubble before COVID even got here. COVID, or the reaction to COVID and how we mismanaged COVID in most places, was just made everything accelerate. And so as a result, we saw in the last year, 30% of all the dollars have been printed. The outstanding dollars in circulation have been printed. And in fact, the Fed stopped reporting the M1 money supply chart because it looks like a hockey stick just going like this in the last year. So, we're looking at inflationary forces in front of us, which could be the cause of a lot of these nominal prices going up. Is just a ton of dollars, more dollars in circulation that make prices look like they're going up, make incomes look like they're going up, make commodities look like they're going up in price. And some of that's a natural function of supply demand imbalance. But when you add that many dollars into circulation, it's inevitable that you're going to see inflation. And so, but I understand that takes about 6 to 12 months, sometimes 18 months to catch up when you print that many dollars and we export all of our debt like we do, right? Or we can export that inflation, if you will, because the dollar as a world reserve currency. But I think if we were like a Japan or another country that didn't have as much international interest in buying our debt, then we would have seen that impact way more immediately because of all the stimulus. And I think that that's not going anywhere. So, anyway, 30,000 foot view, we weren't as economically healthy as I think everybody thought we were. And now the COVID response is accelerating that problem. And had it not been for all of the stimulus that we've had, then we would have already seen a lot of what we saw back in 2008, but it not driven by housing though. That's the distinction, right? Everybody's like, no, there can't be a market correction. Everybody has more equity right now. You're not seeing the irresponsible lending that we saw before. There is true demand as opposed to speculative investor demand like there was in 2008 that set that up. But I don't think people realize that there was an underlying sickness, economic sickness that just hadn't surfaced because it was disguised by record low interest rates and Fed rates and a lot of quantitative easing and or stimulus. So the bottom line is we're waiting for the next buying season. We just don't know when that's going to be because we're kicking the can down the road with the extension of the eviction ban, the foreclosure ban. You and I both know that they were supposed to end that at the end of the CARES Act at the end of March. Then they extended it to June. Now they're trying to extend it to the end of the year. So I think it's inevitable that they're going to face a homelessness problem, and they know it. That's why they keep kicking this can down the road and extending it. Because if you look at, like I've seen some stats say that 1 out of 5 tenants, and by the way, we have a property management company. We manage about 400 doors. So we got a really good pulse, at least in certain markets, what that's looking like. But 1 out of 5 doors didn't pay their rent last month. And you have about 2 million homes that are in some kind of delinquency status, right? So if you were to let these lenders come after homeowners, not that they would, because maybe they don't want to take that inventory back, right? But if lenders had that option and you had landlords evicting tenants, then I think you would have a major homelessness problem that our politicians who can only think in 2, 4, and 6 year cycles, they're not going to want to be the ones to let that house of cards fall on their watch, right? So I think if you are if I'm a believer in anything, it's I believe in politicians' survival instincts. So I think what they're going to do is not let that happen on their watch. We're just going to print a ton of money and just stimulate the dollar to zero value. So I don't know when this is going to happen, but we're taking steps so that we can deploy money and buy distressed assets when this next buying season does come. And there's a lot of institutions and equity firms that are doing the same thing because everybody's hoarding cash right now. And there's so much cash on the sideline that is waiting for good buys right now because everybody's yield driven. So anyway, it's kind of interesting to see what's happening because the yields that used to be there because home prices were here and rents were here. Now on the tail end of this 13-year expansion period, home prices went like this and rents didn't go up as fast. So your yields are getting squeezed. And now it's harder and harder to find those yields in either build to rent product or flip product or anything, or resale product. So, everybody's kind of hunkering down and waiting. So it's really interesting times. So, we kind of have pivoted as an investment company, and now we're focused on just serving the brokerage community because, when you're flipping the amount of houses that we do, you're not in the real estate business, you're really in the marketing business because you know how to get in front of sellers and get discounts on houses, right?
Right.
So, but now that marketing doesn't work because sellers aren't leaving any fat on their houses. They're not leaving the equity on their houses because they don't have to anymore. Everything's selling for ridiculous numbers. And you see these appraisal rider waivers right now where people are paying outrageous prices for houses and they don't care if it doesn't appraise. They're either coming to the table with cash to make up the delta so they can get those things to closing, or they just have excess cash and are putting huge down payments because in my state, which is kind of a refugee state for people that are leaving like other areas where the cost of living is much higher and maybe they have more lockdown restrictions and they don't like, their politics. We're catching a lot of these people that are migrating in the country, just like Texas and Tennessee and Arizona. And what's happening is not only are we getting a lot more demand than we have supply. So as an example, this time last year, we had 40,000 properties on the MLS. Fast forward till now, we have only 13,000 properties on the MLS. And last year, when we had 40,000 properties on the MLS, we were closing about 10,000 a month. So you had 4 months of inventory. This time, this time, same part of the year, we have only 13,000 available listings, but we have 17,000, 18,000 closings a month. So we have only about 2 to 3 weeks of inventory. And then you exacerbate that supply problem because of the supply shock for new homes. And now builders can't deliver houses. I mean, a 2x4 used to cost you $2 or so. Now you're paying $10. The just OSB board for your roof decking is like going to be running over $60 a board soon. I mean, it's insane what's happening. So now you have builders who can't deliver houses. So that new build inventory is off the table. So now resale inventory is even more scarce. And then you compound this problem on the demand side of the equation because people are selling houses for ridiculous prices in higher cost of living markets. They're coming to Florida and they're seeing how much house they can buy. They don't care what the prices are when they buy it. So you got multiple offer scenarios. Again, you got people with appraisal rider waivers. They don't care what that gap looks like. They're still closing on their houses. They have the excess cash. I was texting a buddy of mine earlier today. It's like, imagine being a new home buyer right now, trying to do a FHA loan or a VA loan or something, or USDA, trying to find a house. Like you're screwed. Like there's no housing for first-time home buyers right now. How do you compete?
Yeah, exactly. I mean, myself being a military veteran, I've done 20 years of active duty service. And, I've been talking to some of my friends in different parts of the country, they're using 0% down VA loan. You can't compete. So the affordability factor is affecting the FHA and the VA buyers. So it's really very challenging. Also, John, in case you don't know, I have been promoting Austin, Texas, for many years now. And now I'm back into the Raleigh, North Carolina market, which is booming because of the research Triangle Park and the high tech and what have you. Like you said, 1 week to 2 weeks of inventory of supply, where, you know, in these markets, Austin, I don't know whether you heard or not, in the past 18 months, the Austin market, the prices have appreciated like 50%. I mean, it's ridiculous. There were 100 offers per house is the norm in Austin. And I see the same thing in coming up in the Raleigh, North Carolina area because of a high-tech boom and migration of people. For 1 to 2 weeks of inventory, now people are saying, you know, some YouTube entertainers out there are saying that we can see a crash of 40%. I don't necessarily see a crash or even a foreclosure wave, in my opinion, because of the fact that, like you said, the builders are really, a lot of the builders are pausing building until the cost of lumber come down a little bit before they resume building. And then you have the sellers right now, even right now, as we're heading to the post-pandemic, they're not selling their homes because if they were to sell it, there's nowhere to buy because there's a lack of inventory to buy. So
it's nuts.
Yeah. So how long it takes before? Right now we have 1 to 2 weeks of inventory, which is, you know, shocking. You know, into a 6 months of inventory, which is a normal market. And I think the National Association of Realtors or some organization, they said we need as a country like 4 million homes. Right now we only have 1 million. So when do you think, John, that we can have a normal market whereby the supply will catch up with demand, where we can see 6 months of inventory back to a normal market? I don't know. Every market is different in my mind, so we can't say, you know, every market is going to be the same. But go from 2 weeks of inventory to 6 months of inventory, it may take several years before we have a balanced market of a 6 months of inventory. So I don't see any kind of correction or you know, thing until, in some market, until 2, 3, maybe even 4 years from now. So what are your thoughts on that?
Yeah, I think that, well, to be clear, there's a distinction between a foreclosure crisis and a market correction. So you can have one and not the other. And that's what we think is going to happen. In other words, we definitely see when lenders are able to take their houses back to recover their losses on delinquent loans, we definitely see a lot of those in the pipe. Like, there's no question about whether we're going to have a default crisis or not. And I agree with you, because there's such a supply shortage, that inventory will just get absorbed. So I don't see that affecting prices, especially in markets like the Austins and the Raleighs and the Orlandos of the world, or the Nashvilles, right? I think what we're going to see is, but there is definitely going to be foreclosures. So we know that those are coming. And if you know how to play those, and there's 3 places to buy a foreclosure, right? Or distressed property. The more public that distressed property is, the more competition there is and the less of a discount you're going to find. But the more sophisticated that stage is in the acquisition process, the less competition you're going to have and the more discounts you're going to have. So even though I don't see the foreclosure crisis in markets like we're describing here, where people are moving to, I don't see a major market correction happening unless something happens to interest rates, which I'm not smart enough to know what dominoes have to fall for interest rates to actually climb. But I'll speak to that anecdotally here in a second. I think a big product of what we're seeing on home values, one of the major factors, obviously, is how cheap it is to get 30-year fixed financing right now. So, but I'll come back to that here in a second. So to your point, yeah, I don't see a big market correction happening unless something happens to rates, or it could be a pinprick with the stock market that could cause some kind of domino effect that eventually affects home values. But it has to inch, I think, in my opinion, interest rates up, right, for financing. And if that happens, then we're going to start to see a slowdown, or that could drive a correction. But again, I'm not smart enough to know what has to happen to cascade to actually where interest rates go up, right? But the default crisis is definitely going to happen whenever lenders have permission to actually, these federal backed loans can actually go back and start taking houses. And then if you're chasing default properties, you have your pre-foreclosure stage, which is before the auction sale. Then you can buy at the auction, and then you can buy REO listings or bank-owned properties post-auction. Well, the further you go down that spectrum in that foreclosure, those 3 foreclosure stages, the more public that property gets. So if you wait till a property comes back on the market again, post-auction sale, foreclosure auction, then you're competing like any other house on the MLS, and you're going to pay retail price for it, and there's not going to be any discounts. If you buy at the auction, now you're talking a more sophisticated game. You had to have probably set eyes on the property to figure out what your max offer price is and what the rehab is, if you could even get into the house to assess that, and have done some title work to know what you're getting at the auction sale, right? So that's a little bit more sophisticated game. You might be able to find some deals there. But we like to do pre-foreclosures. So we like to chase and watch what happens with properties that are on their way to the foreclosure sale, get a direct line of communication with sellers off market, and then do workouts with them to get those discounts off market. So that's where we like to play. And that's where we think that's what we're gearing up for. Is we think the deals are going to be, if you know how to work pre-foreclosures for deals, then there's going to be a lot of those coming. And we kind of then sidestep what's happening with the regular market, because we're dealing with distressed property owners, and we have a lot of creative solutions to get discounts on those deals. Not every time, obviously, but more so than if we waited something to get further down that foreclosure pipeline. So to your point, yeah, we don't see a major correction with real estate considering the supply demand imbalance, unless something happens to interest rates. But it's inevitable, I think, that these foreclosures are going to happen, because we're just seeing that delinquency climb. So we'll see, man. Like, it's interesting. 2000, I did some analysis, and this was back, if we look at when home prices were at their peak at the tail end of 06 and the beginning of 2007, that was peak pricing. And I think peak pricing back then was about I want to say it was around 265,000. Well, at that time, your interest rates were about 5.5%, right? If you go fast forward to about this time last year, the average home price was about 300,000, right? So just over 300,000 median home price. But what's interesting is that if median home prices at the peak of right before the financial crisis was 265,000, and now we had average home price, median home price of 300,000, but our interest rates back then were 5.5%. Interest rates now are about 2.753%, right? Then what's interesting is if you look at incomes back then till now, the median income back then was 60,000. It's only 63,000 now. So here's what's interesting: 17% increase in home prices from then till now, but only a 3% increase, or less than 3% increase in median incomes from then till now. So really, that expanded buying power came because of lower interest rates. And I think that was obviously the number one factor in prices getting to where they are right now. And now you have the supply shock that we're contending with. So that's exacerbating the problem. So really, I don't know what would potentially lead us to higher interest rates, but that's really going to be the factor or the dial that, if ratcheted up, is going to have more of an effect on home prices or not. And I don't know if that's something it would obviously be something that I think would be involuntary. Like, in other words, there was no choice but to jack those up. It's not like anybody's going to like the Fed's not going to increase the Fed rate. So because they can't afford to. I think it would be so screwed, and everything would collapse if they did that. So anyway, that's kind of some factors that we're hawking right now. Though we know that, look, we're not buying houses at a discount. So our whole marketing engine to get in front of sellers off market, we're not monetizing that right now by getting houses at a discount, because no one's selling at a discount. We're monetizing that marketing right now by helping the brokerage community get in front of sellers to list their houses, because everybody wants max price for the houses. So that's kind of what our focus is right now. But we're training real estate agents to be able to buy houses at a discount and work the investment angle and analyze properties, so that we have an infrastructure through our extended national brokerage community to be able to buy on the backside of this. Just don't know when that's going to happen, man.
Yeah, well, John, I know you for many years, and you have the ability to adapt to different real estate market cycles. and in this current situation is no different. So I know you're planning. So you are just looking forward to the foreseeable future. I'm sure you can find something. So yeah, I mean you act like a I've been hearing the single family uh, homes, or I know we only have 5 minutes left. I would love to talk all day long, but you are providing some great education for. Anyway, so I see single family home investing is really the best the asset class of choice. So that's where I'm taking my turnkey investors into single family homes in good markets. Like I said, well, Austin, that's kind of that's over. So can't do that anymore. I can't cash flow anymore. But we're doing San Antonio, we're doing Raleigh, we're still doing Florida, Central Florida, Southwest Florida, Cape Coral. We're still doing well. Florida, right? You live here in Florida. So but the yield is quite low. The cap rate is only like 4 to 5%. But the people, at least for the next 2 or 3 years, we're chasing appreciation. I hate to say the word appreciation, right? I mean, you buy for,
Yeah.
but I mean, I don't know.
Appreciation, inflation, still a hedge, right? You know
Yeah,
what's interesting, to interrupt you there for a second, because I know we're running out of time, but we're seeing, I don't think people realize the precedent, to piggyback on what you were saying about single family homes, as being first of all, a great inflation hedge. But when you do a leverage purchase, you get financing in place, in an inflationary environment, in a single family home that cash flows, and we're only talking like, you only need like about a 5 cap. I don't think people realize this, but if you do the numbers with some very conservative assumptions on a house that I buy, say for $200,000, and it rents for, let's say, $1,500 a month. So let's say 0.75 rent multiplier, right?
right.
Then, and let's say that on a conservative vacancy assumption, maintenance reserves, your typical property management fees, because nobody wants to adopt a second job owning a rental portfolio. They just want passive cash flow, right?
Right.
If you do that with a 30-year loan, then the after-tax net benefit, if you really compare apples to apples to other paper investments that other people are investing in, mutual funds and that kind of thing, you're actually after-tax net benefit like a 15% return on your down payment money out of pocket. So like 15% net cash on cash return to 25%. So you really only need to be at, like, for anybody who follows like cap rates and commercial lingo, a 5 cap, 6 cap, and literally you're netting 15 to 20% cash on cash return on your money when you account for the tax write-offs, depreciation, interest write-offs, a nominal appreciation rate. I'm talking just the 3% historical average. If you account for the net cash flow after tax, and then also the principal or the equity you're building by virtue of the principal paying down from the tenants, I mean, you're doing outrageously well. And then against a small down payment, if I think if we're coming into an inflationary environment, people don't realize that by owning a rental property with 30-year fixed rate debt, mortgage payment stays the same, but rents are going to increase, at least the nominal price for rents, right? The rent rate's going to increase. The home value is going to go up against your small down payment. Like, there's all kinds of advantages, assuming you're able to buy something with a little bit of debt service coverage. So you have some cash flow there. You're resilient. You can wait out any kind of market correction if there is one, right? But which we don't see in any time in the foreseeable future. But so yeah, we're really getting ready to come back into the market. People don't realize that for the first time post 2008, you had a lot of financial institutions and equity firms and hedge funds and institutional buyers. They, for the first time, started to buy and stabilize rental incomes on single family homes. And so that was a precedent that was set for the first time, for the most part, in our country, that had never been done before, because a lot of these institutional investors always did commercial strips or multifamily buildings before that, because it was easy logistically to buy and hold those types of yield vehicles. Well, post 2008, now all of a sudden these institutional investors, because they saw the returns and because of the low cost of money, they were able to buy what we call scattered site real estate. So now single family homes that are spread all throughout a city, they figured out the logistic challenge of having property management, of having construction crews, maintenance, and all that over a whole city. So what's interesting is we saw home ownership at its peak prior to 2008 was at 59%, right, across America. Then it dropped to 53% by the time we got on the tail end of that crisis. And then since then, in just the last 13 years, while everything has been getting better, we've only come back to 54% home ownership. So those 5% of our population that became a forever renter or permanent renter, and now that we see this assembly line set up, so all these institutions, they have pocket full of cash, they've slowed down their buying, but they've got their property management infrastructure in place, their acquisition infrastructure, their maintenance crews, and all their construction infrastructure. They're ready to go again, but they don't have the raw materials on one end of these houses that are going in the assembly line to come out the other end as rental properties that they then stabilize, right? So it'll be interesting. I think to your point, those single family homes are the yield vehicle in an environment where you have this pension crisis and this retirement crisis and this yield crisis that all this money is looking for right now. It's going to be in single family. And so it's a nice wave to ride if you know that you can get in with somebody who can deliver turnkey. And it sounds like an advertisement, but it's not. If you can find single family homes, 5-6 cap or better, and you can get 30-year fixed rate loan, then just ride that wave, because it's just going to go, it's going to be a great hedge against inflation. I think inevitable inflation.
Yeah, I agree. Well, we can talk all day long. I mean, I would love to invite you back for some future podcasts, because we can talk about many different topics, subtopics. We can break it out into chunks. But your times are very limited. You do a lot of deals. You have a lot of clients to take care of. But one final thing. Some of my investors, some of my turnkey investors, of course they are taking the plunge. They're pulling the trigger. They buying 2 or 3, 4 properties there all at one time, really, with mortgages with 25% down, with historical low interest rate, and they buying in those good markets, break even cash flow situation, 250K, 300K homes in the hot market like in San Antonio, Raleigh, and Southwest Florida, Cape Coral, and even Central Florida in your neck of the woods. So whereas some of my investors, a lot of them are newbies, that's very, very challenging. They all stay on the sideline. So what is your parting thought? What is your recap in terms of should turnkey real estate, mom and pop real estate investors, not the Wall Street hedge funds that you've been talking about, mom and pop investors that I work with, I mean, you recommend them to pull trigger right now before, or you may recommend for some of them to stay in the sideline?
Yeah, no, I think that if you can meet the condition of that five cap or better, and you can get a 30-year fixed loan, you cannot get hurt owning a single family home right now. So the trick there is just to make sure that you don't have any deferred maintenance on houses, so that when you buy it, you get hit with 20 different repairs afterwards,
right.
Which isn't an issue if it's new construction, right? Assuming you can even find new construction. But yeah, if you can find, basically there's a couple criteria, high level, go into, I call it red state markets. So not to get political, but they just happen to be no rent restrictions, easy landlord experience, easy evictions. Go into an environment like that people are moving to, so you're safe that way. And if you get a 5 cap, 30-year fixed rate, no deferred maintenance, you can't get hurt on it, because home prices are only going to go up, nominal values anyway. They're only going to go up. Rent rates are only going to go up, and your fixed rate debt's going to stay the same. So if you can find that, yeah, pull the trigger, because you can't get hurt.
Well, John, you are a very, very knowledgeable, very smart, very savvy investor. I always value your advice, and today's podcast no different. To be honest with you, I've watched YouTube channels, real estate from time to time. I observe other so-called experts in what they're talking about over the past few years, and I have to say that none of those individuals, they have presented the way you present it, in such a high level way, in a very, very data driven. It really makes sense. I mean, you cover so many great areas. Yeah, I really value your advice. A lot of investors that are listening, and in the YouTube world, they need to take listen to you more than any other those so-called overhyped experts, so-called experts out there who have know a lot less than what you know. So anyway, yeah, we can do business together, right? We've been doing business off and on for many years, and when the pre-foreclosure business model comes back, we don't know when, sometime in the future, I will start working with you again, and I will send some investors your way to help them to take advantage of that particular niche market that you're into. So thank you so much, John Chin. And hopefully we'll invite you back to talk about some other areas of real estate. Thank you so much.
Would love it. Thanks a lot, SeeWing.
All right. You're welcome. Have a nice day. Bye-bye.